not winning 90% of your new business because you have some sort of incredible value.
I'm going to take a bit of a different angle.
You know, I've got a budget this big. I'm going to give it to you because you have a really killer plan.
You give a Red Bull to a turtle, what do you expect?
I think that's a dead turtle.
So let's move on to...
E-break.
Cheers.
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 Does your current premium finance company lock you into long-term agreements? That's because they don't want you talking to us. At IFS, we win your business the good old-fashioned way, with customer service. I know you don't always have to use a premium finance company, but when you do, you should use IFS. Cheers.
Hi there, and welcome to another episode of the Digital Insurance Pint podcast. I'm your host, Tom Reed, and as always, I'm joined by my colleagues, Adam Mitchell, a CEO of Mitch Insurance.
Hello.
Jeff Roy, CEO of Excalibur Insurance.
Welcome, Pinters.
And Steve Earle, CEO of Cheap Insurance.
Good day.
And if anyone knows what the acronym that Steve has at the bottom of the screen is, you can direct message us through LinkedIn and take your guess.
Free what? Free shirt?
Free Say No to Portals t-shirt to the first correct guess. All right, guys, today we are talking about existential threats. You know, we're in 2023. There's all kinds of things going on in the world that are existential threats to the rest of the world, but we're going to keep it micro-focused on the broker channel. So this is almost a what keeps you up at night version 2. We did a version of this back in season 1 a few years ago, and we're going to update it for 2023/2024. So there has been a fairly high level of change in the industry, and we're going to dive into some of the things that we think are either the most dangerous or the most concerning to the industry. And as always, I'll get my colleagues to chime in with their ideas and have a vigorous debate about it. And Adam, I think you are the holder of most of our problems, or the identifier of most of our problems.
Call me Chicken Little.
Chicken Little. All right, Chicken Little, I'll give you the mic first. What, in your opinion, is maybe not the most, but one of the most biggest pressing issues in our channel today?
Well, I'm not sure this is the biggest, but it's certainly front and center. It's a new thing that's happening inside these recent years, and it's vehicle theft. And I just came out of an Intact broker dialogue session, pretty informative, pretty good, and they said historically vehicle theft would contribute 1% to their bottom line. As in the total sum of the loss ratio combined would be 1%. And in this last year, it's been between 5 and 6%. So it's a significant gain in what's happening. And they were mentioning it first took hold and took traction in Quebec with the closed ports there. And they started to get on top of some of it with the tag and some other. And now it's migrated over to Toronto. And they're maybe starting to get some foothold there. And they said now they're starting to see it pop up north into Sudbury. And leave it to the criminals to be innovative and pushing this envelope. And it's a zero-sum game for the insurers. It's a pain, but then the rates will go up and it just gets passed on to the consumer at the end of the day. I think there's a lot of discussion on what's the obligation for manufacturers to start to contribute to this. And some of the dialogue we had is like, can you get into equivalent of 2FA for cars? Can you have it so you need to authenticate the car on your phone? You need to have both devices to be able to start. I saw something advertised the other day where it's an aftermarket implementation to your system. And to have the vehicle start, you need to press a series of buttons on your steering wheel to unlock it. So it turned your steering wheel into an unofficial keypad. And I thought that was neat to start to get on the offensive of actually preventative. Because what's swept through our industry is the recovery side with the tag system. And, there's some rumors that tag system can be blocked by signal jammers that you just plug into the cigarette lighter.
So criminal behavior has added around 5 points to the loss ratio, which would turn into, a similar price increase, all things being equal for the end consumer. I know that this information is a few years old. I assume it's still going on, but fraudulent activity, whether that's underwriting fraud or claims fraud, in the past, like I said, this information is a few years old, but in the past could add up to about 10% to the price. So you're looking at criminal behavior is adding, almost 15% to the price tag of an auto policy.
Well, and it now bumps the difference between, like, if you had a company with a 95 core and a company that's 100 or 96 and 101 or something, you're the difference between a phenomenally profitable business and an unprofitable business. Like, it's a crazy impact that's transitioned inside 24 months.
Well, the margins are so small in insurance that any sort of negative impact from something, risks going from good to bad, very quickly, obviously.
And over a long enough time period, it's a zero sum to the insurance companies. Like, it will all get passed on to the consumers at the end of the day, right? Because it'll just redistribute. And what's not being talked about a lot is like the sort of mental trauma when these things are disappearing out of your driveway. And by the way, they're not sitting on lots where you can go get a replacement, right? Like, it's not odd that you'll wait 6 months for a replacement vehicle, and that's a real problem.
What's the duty? Like, some of these cars are easily broken into and stolen. So some of these manufacturers going to kick it up a notch, right? Like,
well, that's what I was going to ask Jeff too. Is like you can't, a criminal can't hack into my $1,000 iPhone. It's useless to them, but yet he can steal my car, my $80,000 car, pretty quick.
yeah, like, and you get the steering wheel locks, you got the Faraday boxes that are supposed to block the signals from your key fob. You get the tag system, as Adam mentioned. Like, there's ways of combating it. And again, companies have jacked if you get a certain type of car, you live in a certain area, or you just have a certain type of car, it doesn't matter where you live. You're getting a $500 surcharge now automatically in your insurance unless you put one of these anti-theft devices in, right?
What incentive do you have to solve this when the consumer at a macro level doesn't care? It is inconvenient and traumatizing, but they're going to be made whole, right? The manufacturer sells another one. No one's going to listen from the insurance company screaming. It's a bit of a problem. Now everything is old is new again. Enterprise Rent-A-Car is using the club. They're buying them by the shipping container full to try and keep Dodge Rams on their lot, right? And even one of our insurance companies is now endorsing that as a preventative measure. Like, which short seller or hedge fund brilliant person went in and bought this distressed company that was the club, only to see that thing turn around and go through the roof?
Okay, let's change. Let's move from auto over to the property side here. We've gone through this year one of the worst wildfire seasons ever, and maybe Jeff, I'll get you to talk about and most people are saying that's an impact of global warming. How is that affecting reinsurance, right? We know reinsurance has a significant impact on our day-to-day lives, on pricing and underwriting and risk selection, et cetera. Where do you see that going, Jeff? What are you hearing around reinsurance pricing and availability?
Yeah, it's fairly new. I was just at a farm fire summit in Cambridge last week, and all the farm mutuals from FMRP were there. The Ontario mutuals were there. Obviously, Walmanisa, Intact, and in the farm industry, there's a huge problem because all the number of farmers are getting less, and the values are getting higher. And when there's a loss, it's not $1 million barn anymore. It's a $9 or $10 million dairy operation, for instance, that goes down, or you get a big barn fire with hay, you can be into 3 or 4 or 5 million pretty quickly. So the issue they're running into is just the reinsurance capacity. A lot of the reinsurers will potentially only want to take a certain limit. So we might have to get more subscription policies in place. Some of the insurers have already come out already and announced that, hey, they only want to take $5 or $6 million of a risk. And then you have to get a second insurer on board, because each of these insurers are getting increases this year. And I'm hearing different, numbers like 5, 10, 15, 20, 25% increases. So it'll probably depend, obviously, how much of retention you have. It'll depend how much, if you pay the first, $1 million of the loss and the rest is picked up by reinsurance. A lot of the farm mutuals, for instance, have taken a higher retention limit, but that means when there is a loss, they're going to get hit a bit harder. So you factor that into all the other industries, commercial and everything. There's a number of factors hitting our industry right now. If you talked, I was down in Bermuda Florida in April, meeting with the reinsurance market there, and they deploy about $100 billion or $120 billion of reinsurance out of that market. And there's some major elements hitting them. It's not just wildfires, Tom, and that's one of the things. Obviously, wildfires and environment, but liability lawsuits in Florida and Texas are hammering the market too. I think everybody remembers the tower that collapsed in Florida. I don't know if you remember that case, like a year and a half, 2 years ago, where the tower collapsed and 120 people died.
Oh, is that an
Remember that?
apartment tower?
Yeah, like apartment tower,
Yeah.
condo tower. Guess how much was paid out in that lawsuit?
No idea.
$1 billion was paid out. So
Wow.
I'm just like, who carries $1 billion? But I guess inevitably the 500 million was covered by the building owner, but the security company, the person didn't do what they're supposed to do, and they're on the hook for $500 million too. So you get some settlements like that. You've got, obviously litigation causing a big issue. You've got the war in Ukraine, which you wouldn't think that's a big issue, but obviously it's driven up costs, and obviously there's a number of things I guess that are covered that have war coverage. So just another factor in there, and you add interest rates, inflation into all this, so it's kind of a number of things hitting the industry hard. And again, I don't think any of this has all happened at the same time. That's the other problem. Like, you've had times in history where one thing's happened or two things, you got 5 or 6 or 7 elements right now driving costs up. So, I saw somebody that mentioned that they thought reinsurance minimum 5% in some areas. 5% is treated as flat. I saw that actually this week on LinkedIn. But it'd be interesting to see what all the renewals that are going on right now, how the insurers are making out, and how much they're going to have to pass on to the consumer. I had one person tell me that if they passed on the direct reinsurance cost to all their policyholders, it would be $80 a policy if they did make any changes in their policy, which that's pretty alarming. $80 a policy, right across your board on every policy. So again, consumers with other increases going in on top of that, inflation is only one thing. Obviously the losses are bad, and companies, hadn't got the investments. Mind you, they should have improved a bit this year, but they've got a lot of factors making it difficult. So anyway, just kind of a challenge. I see it definitely in the farm market's going to be hard. I think the commercial still going to continue to be hard. On Steve, I know you've got some big apartment buildings and high limits. Is that things getting easier to get insurance? Are you having to get more?
No, of course not. It's not getting easier. And I worry about HAB a little bit too, if we're talking about existential threats and the cost of reinsurance and all that. Like when you're looking at what's currently a distressed economy, affordability is key and at the forefront of everybody's mind. And when you look at the cost of reinsurance and the cost of losses on HAB, it's going to become unaffordable for the average Joe. They're getting hit with their mortgage, they're going to get hit with insurance as well. My fear is that with that, does habitational all of a sudden become a regulated product as well? That is a threat.
Have anybody heard any regulator speculating about that, musing about that so far?
Regulators sniffing around HAB? You hear tidbits on and off over the last decade, but are we heading into this perfect storm of when they get enough calls on it now?
You think this might be the start to dominoes tipping?
Hopefully not.
Okay, so we've got vehicle theft, reinsurance, keeping everybody up at night here so far. Let's just keep digging the hole deeper. So I know in Ontario there's been a new sort of take all comers rule, trying to address market behaviors and a few other things. Adam, do you want to quickly run us through that one and talk about the implications?
Yeah, I mean, my understanding from the regulator is that they can't approach any part of auto reform until they can sign off that they're on a good governance and a good management of the current rules and regulations. So it became apparent to them that they were not in good standing in managing take-all-comers, and so that turned into a full court press of REBO and regulators and insurance company interviews and investigations to make sure everybody is signing an attestation and in compliance with it. And we saw the judgment come out and the ruling against some with penalties for Aviva, and who knows how that all came about. But I think what we're also now seeing is you've taken away any of the insurance company's ability to navigate that space with tact, albeit maybe some were abusing it and offside, but being able to re-underwrite files and tackle books that are not profitable was something that the industry had figured out how to do and survive inside. Now, what seems to be there is all the insurance companies are terrified to be offside of this, but the regulator has said you can choose who you do business with, so you're not beyond canceling brokers. So now it looks as if their only ability to rehab a book is to cancel a broker, which when they brought in Take All Comers to enforce this and be very fair and safe to the consumer that's out there, one thing that is not good for consumers is to throw thousands of them to the street at a time because you can't re-underwrite the book. So the broker's handcuffed and cannot do anything outside of it. The insurance company's handcuffed and cannot do anything outside of it. And the regulator saying, well, you can break up. And then the consumer just gets to start the process again. And lo and behold, fill out a new application.
So let me test a theory with you. So the way I look at this is, insurance companies are trying to underwrite and price risks to as closely as possible so that each individual pays, according to their risk profile, right? So a good driver who is projected not to have accidents, not get their car stolen, vandalized, hailed on, whatever, will pay less than somebody who's deemed more likely to have an accident, get hailed on, car stolen, whatever, right? So one of the factors in that is where that person lives, and typically they're dealing, in a lot of cases, you're dealing with a broker that is in their area, right? So in my area, we get hailed on a lot, right? So let's say that carrier X decides, well, we don't want, we're paying way too much for hail damage. We have to take this car. We have to provide it with hail coverage. Might be a bit stretching a little bit there, but we're going to cancel. But we don't want Tom anymore because his car gets hailed on every year. The only way we can get rid of him is to cancel his broker, who's in that part of Calgary that Tom lives in, thereby also getting rid of all the other hail attracting vehicles. Oops! And now every other carrier decides, oh, that's a good idea. Let's do that too. At what point does Tom stop being able to buy insurance at at all, or even a semi-reasonable price? Like, at what point does that stop? Like, if one carrier, the first carrier that does it, great, they're out of the woods now. They don't have to deal with that area. That broker has a problem, but now other carriers start doing it. Like, doesn't this risk having a snowball effect, and like really, really displacing people that were the point of not being displaced in the first place?
Well, the big thing is like Visera, like the insurance companies had a very difficult time in getting rate and filing rates and getting rate increases. Took a long time to get through. Now that's supposed to have improved. I don't know. I'd have to ask the companies if it has or it hasn't. COVID and the government enforcement to drop rates, even if it was faster, they weren't allowed to. So it'd be interesting if they can actually get to rate faster now, because obviously if they're losing money, they need to increase the rates. But if you're enforcing it on the one side, you can't stop it on the other side. So it'd be interesting how that's playing out. Does anybody know how that's going for companies filing?
I don't, but let me tell you from my experience, carriers try to get rate first, right? If they can't get rate, like canceling a broker, doing something dramatic like canceling a broker is typically the last behavior that they put out there. So, if that's what's going to drive that, I'm not sure. And by the way, it's no insurance company is ever going to tell you they're getting rate fast enough, right? The government would never, the government has never ever reacted that quickly. So I'm not sure they're going to be able to price their way out of this.
The other issue I have right now too is I believe Visera is going to basically start making the insurance companies audit the brokers, and currently right now it's not standardized. So if every company has their own version of an audit to make sure you're following the Take All Comers market on top of Rebo auditing it, it's going to get very interesting. So I know Colin Simpson's doing some work to try and standardize that to make sure the auditing process is consistent. So I know IBO is out in front trying to help make sure that's going to go properly.
Yeah. So, but I think the argument that Adam's putting forward, and correct me if I'm putting the wrong words in your mouth here, Adam, but you're saying the point of the Take All Comers rule is to provide access to market for the end consumer. if the resulting behavior is such that brokers are taken out, that also prevents access to markets.
Totally. So I am a broker. I take in Jeff's phone call. I fill out the application. He gets a price. He takes that. Turns out the underwriter did not price in margin, so they don't make money. I've now signed up 1,000 Jeffs, done my duty. Jeff did his duty. Everything was forthcoming. And now the only way to go back at this, if they can't file for a rate increase or whatever is holding them back from that, is cancel all the Jeffs. Jeff, go talk to Steve and start again.
Are you going to cancel the Adams first, then which cancels the Jeff?
Well, yeah, it's a part and parcel, like a package deal.
Don't forget the Adam part. Come on.
the two guys that didn't have anything to do with the margin, now there's nothing else we can do within the regulation to have it. So you're now down to blunt tools. And the part that I'm pointing out is that that also now isn't good for Jeff, consumer.
It comes back to some accountability for underwriting too, right? Like at the end of the day, the underwriters seem to have all these billion algorithms and we can't figure out the black box underwriting, yet when our results are bad, it's all our fault because we're supposed to have some nebulous superpower to see things better than everybody else. And there's very limited tools out there we can plug in with an API to assess consumers. There's tools out there that we're all aware of, but they're very expensive and it's very tough to get them piped into your system at $5 or $10 a quote. And there's no even chance the reliability is there. So what else are you going to do as a broker to magically, be able to get all these perfect clients that are priced perfectly in the book of business, right? So it's a very interesting game right now, and hopefully the market will catch up and the actuaries will get better at their job.
I'll say the company, you talked about the underwriter making a mistake and not getting margin. I'll push back on that a little bit because the underwriter needs to be able to make decisions on things that actually affect the future profitability of that risk. Location is absolutely one of them, right? That is a very high determinant of that. And there's a number of other things, age and sex and how far you drive and all kind of stuff. And some of these things are being challenged. And in this case, when you're being required to take risk into your main company at non-facility rates, where you're being forced to take risks that are outside of the tolerance of what you're normally doing from a pricing perspective, is going to upset the system, right? So carriers do not cancel brokers for the hell of it. They cancel brokers because it's a last resort, and they're being pushed to that last resort because of decisions that are getting made, in certain regulations. So
there is a few, right? There's now seeing cancellations because they're trying to unburden their service load. It's growing too fast. We're seeing cancellations for capital limitations. But now the other one is the profitability. When they can't make sense of it either, this is a blunt instrument that allows them to go that way.
So you mentioned that there is at least one carrier who has canceled brokers because they can't manage the volume of business coming in. So they have on purpose canceled the contract because they can't manage their own growth. That has got to be one of the dumbest things I've ever heard. In what other industry do you slow down your growth because you can't hire a few people to process and policies? That is gobsmackingly stupid.
In what other industry are sales not celebrated? If you're selling widgets, you're quite happy to sell 3 more shipping containers full of widgets. And we're in this one other industry that isn't like that. Yeah, but that is in full compliance of take all comers. But not saying yes to the person is not. I get that it's complex and we're living in a broken system of things, but it just drives me bonkers.
Well, the other thing too, though, is if you have certain companies, though, that they can't raise capital because they're not publicly traded, they have to be able to make a profit to turn it back into it. So sometimes, yes, you're growing to. So if you can't raise capital and your rates aren't competitive and you're in a bad spot, it makes it super difficult. So you got to look at some markets just can't flick a switch. So if you have too much business, you're not allowed to get proper rate. You have to do something, right? You're forced to take some action.
Yeah, so I get that, slowing down new business, that kind of thing. That's completely understandable. Canceling a broker, canceling a source of growth because you can't manage your service levels, right? Because Adam talked about two separate issues. One was the capital side, one was the service side. The capital one I sort of get. You can slow down. I don't think you have to cancel people over it, but canceling somebody because you can't.
Tom, it doesn't sound it almost feels like, because you can't fix things on a policy by policy basis, you have to do it on these large volumes all at once. So it's, hey, guess what, Adam? You get a $2 million book with us. We're going to cancel it. But then we're going to give you a new contract tomorrow and you can grow organically again because we feel that we can fix new business, right? On a policy by policy basis.
That's happened. We need to bleach this entire thing from the system. And then a year or two later, we can do business. We've cleaned it up and we can go back.
How about the next day?
And we've done this all in the name of staying to the best practice for the consumer, compliant for the consumer's regulator. Right? Because we have all regulators are there for the consumer, and okay, that's not a bad thing. But we got to call a spade a spade. This is broken.
Okay. On the subject of other things that might cause a collective stroke here, let's stay with Adam and talk about OPCF 49. What the heck is OPCF 49, Adam?
I don't know. I think this is what happens when you ask people from outside the industry to solve nuanced problems in the industry. So it's removing a direct compensation feature. So your direct compensation is there so that your insurance company you've decided to contract with, and hopefully you've decided to do business with them because they're reputable and handling claims well and doing that. Well, they will hand you back the money for not at fault claims. By going into this newfound wonderful feature, you no longer can collect money for not at fault claims. So it's turning the general public and clients into underwriters to take the guess as to if you would like to save money on your auto insurance, and it can be a chunky little bit of premium under this. Would you like to take the risk for someone else rear-ending you in traffic? I don't know who has decided the public is ready, willing, or able to actually understand this risk. And I saw a fun post online where somebody said the Venn diagram of people who are going to use this and unable to afford using this is a perfect circle.
So let's take a step back here for the non-Ontario folks. So basically what you're saying is, today I'm in my car, I get rear-ended, my insurance company takes care of it, I'm not at fault, they pay it out, they take care of it, I get my car fixed, I'm good, right? Going forward, if as a consumer I choose to tick the box that says I want to save $400 or a few $100s off my insurance premiums to take the risk, when Joe Schmo rear-ends me, my insurance company does not take care of it. I now have to go sue that guy or do whatever I have to do to get my money back. Is that the case?
That's the case, but you can't sue them.
Okay, so I can't sue them. So I get rear-ended, I don't have this coverage, I am screwed. Is that how that works?
No, but you're paying out of your own pocket is the angle. It's my point is that, like, I don't think people realize the amount of risk they're taking on if it's not very thoroughly explained to them by a well-intentioned and well-informed and articulate advisor, right? If the advisor misspeaks or misunderstands or doesn't take the time or the client doesn't comprehend it, right? Here, okay, let's take a little side one. We're sitting in the same intact My Drive discount thing. 40% of the people signing up for new business are signing up for it. A massive amount are not following through to actually register when they get onto the policy. When asked, hey, why do you think there's the fall off, the drop off from the 40% sign up to this? Well, people are hearing the discounted number and saying, yeah, sure, I'll sign up for My Drive. Sounds harmless. When they actually get the text and do it, they didn't understand, they don't want Big Brother watching, and or it's no longer agreeable. So fitting inside the same thing, what is just a fall off of a 10% discount in that case for signing up, now you have OPCF 49 that is going to have, well, you could write off a $40,000, $100,000 car and not realize you do not have coverage for that. And the accident had nothing to do with you. It was not your fault. You were a perfect driver. You cannot stop being rear-ended.
But you saved a couple $100 a year on your insurance premiums.
And I sure hope you took a smart risk balanced assessment of that savings, right? Like, no.
I'm thinking of how we're plagued by we're bogged down in bullshit, whether it's portals and processes and things that are taking longer. What level of cover our ass process has to be engaged on this endorsement, right? Because the first person they're going to come to when that $50,000 truck gets rear-ended and written off is, I didn't know. It's the broker, right?
Think of an unscrupulous salesperson. Think of a salesperson trying to just get a sale done that doesn't want or care about any of this accountability go forward.
So the endless procedures in our offices in order to make sure that this is all covered off, like the book just gets thicker and thicker.
Well, and even if you have people, you explain it, you have a recording of it, you get them to sign on the endorsement, you get them to sign. I know some people are going to sign 2 different documents. So the amount of work to get people to sign off that they understand it, only to have a claim and have claim amnesia and not remember what they bought and be disappointed, it's just going to create a lot of fury for people that maybe can't afford the loss at that point either. So,
All right, Adam, I'm gonna hit you up again here. So another one, and this is more, well, I guess the implications of this are fairly far-reaching, but we've been talking about embedded insurance in a number of things recently. A lot of that's been on the auto side, and you told us that you've seen some activity with GM/OnStar.
Yeah, there's some loss data coming out of the Tesla. Right, it was going to be priced significantly better. It was going to have all kinds of loss performance better. They're now losing 20 cents on the dollar. Right, is the file public numbers of it's a 120 loss ratio.
120 combined. Yeah.
Yeah. Be curious to know if that's even combined or is that like the loss. But either way, you see, you price it up, you price it down, things will move around and have it. But there's going to be disruption. So as a broker channel podcast, as an existential threat, you got to map this one. It now is in market, has some traction. You may argue over some of the viability of the pricing and actuarial data, but this is kind of how these things start, right? You underprice the product to grab a bunch of market share and slowly ratchet up and raise the price. We've seen it time and time again with Tesla, with Lemonade, with other markets. It's how you come to market, and how are you going to plan to navigate through that kind of marketplace?
Yeah. Well, there is a nice sales aspect to it too, especially in this day and age where everybody is thinking about monthly expenses, monthly recurring revenue, trying to match the two, blah, blah, blah. You go buy a vehicle, either you're leasing it or financing it or whatever, you can throw in, my daughter bought a car a couple of years ago. The maintenance is part of her monthly payment, right? It got bundled in there. To bundle in the insurance from a 25-year-old consumer's perspective would be a great thing. It's all, it's my car. Give me the key. I drive away, one price for everything I need. The car, the maintenance, the insurance, everything. Super convenient from the buyer's perspective, right? Of course, that cuts out distribution. It probably cuts out a lot of awareness about the product from the consumer's perspective. What are you actually buying, right? When it's just all bundled in and it's super easy, you're not going through the process with a trusted advisor. There's probably opportunities for a significant lack of awareness and therefore lack of value from a consumer's perspective. Not to mention bypassing the broker and their input. But I don't know. Do you see any other besides the obvious? Do you see any other sort of negative impacts around this?
Well, you have the thing Steve said about the anti-selection angle of if I'm priced out of the market because I have a couple DUIs. And I can now buy this bundled product and get the new car with insurance, I might actually be getting a really nice car for the cost that my insurance would cost if I was individually underwritten.
Yeah, if I can get a Silverado with the insurance thrown in, the first thing I'm going to do when I get my license back after a DUI is lease a Silverado.
Well, take Porsche for example. So Porsche has the I forget the name of it. I should try and look it up. But you can go and at the high level of membership for a few thousand a month, pick up a new Porsche every month or maybe a couple times a month with all the leasing, all the maintenance, and all the insurance included. It works kind of like a rental car, but you're getting a fantastic, maybe one of the world's best cars with your insurance included. And I don't think it has anything to do with how many tickets or accidents you've had.
No, Porsche drivers clearly don't get into accidents, right? Or have their cars stolen, or like speeding.
I mean, maybe there's some underwriting pieces where you need to have a clean record to qualify for this. I don't know.
I don't know. I can't see a car dealer not selling a car to somebody because they might crash it.
I don't think they care at all, right? And then somebody at head office is negotiating with the other insurance head office, or more likely, like a reinsurance, like just reinsure your balance sheet and you take the risk. But is insurance just going to become an extended warranty for these sort of things? Like, I just picked up a new Hyundai Palisade, and I've been kind of awed the little technology advance just in the last 5 years. The thing's got sensors on all the sides. It's on the heads-up display. It's painting a picture of all the cars around you. If you turn on the turn signal on the highway, it starts merging for you after it's cleared the lane. Like, okay, I'm getting to do less and less of this driving. So inevitably, I should be paying less and less of the risk, shouldn't I?
Well, that could solve the problem right there, because at some point when it's all robot driven, you won't need insurance because you're not driving anymore.
But now that's the ultimate existential threat to this episode of, like, for brokers. Are you prepared for the way these trend lines are going of self-driving cars, self-insured cars? Like, these things are all in market being tested. They're subscale right now, but give it 10 years, it's probably going to change.
No doubt. No doubt. All right. This episode just keeps getting more depressing. So let's
We haven't tackled the really negative stuff yet.
well, let's go to Steve for that. Steve, we in our very first What Keeps You Up at Night episode, we talked about connectivity and technology, lack thereof. You sit on the CSIO board, you sit on iBack Tech. You're one of a small number of brokers who is very much an insider to what's going on there, along with Jeff and a few others. But have we progressed much in the last 3 years?
I would say, yeah.
Okay.
We haven't seen the results yet, but I would say that the biggest thing for sure is the at CSIO anyway is the mandate to begin to govern standards. And ultimately, it's like this: that if you're talking about existential threats, broker channel, and that sort of thing, we're just unable to deliver a value proposition that the directs can, because we deal with multiple markets. There is a process by which connection can be made between that information between the broker and the insurer, but some historically have not been looking at, some, actually all insurers for the most part, haven't been playing by the rules and have had little to no regard with respect to what a standard means, how it's programmed, and so on. It's an afterthought, and it's something that it's been a bit of pain. But this is the thing that is, to me anyway, my personal view is, this is the biggest thing that stands in the way of the broker channel recapturing market share from the directs, is our ability to deliver in the same way, be it speed and customer service and all those sort of things, not just about saving money, but to service the customer adequately, and get market share back. It's the biggest thing standing in the way. So yes, progress have been made. The framework is there. Let's see what comes out of it, and that's governance. It used to be that here's the standards, and people would interpret them their own way, whether it was a BMS interpretation of it, or an insurer's, or an implementer of Guidewire like E&Y and Deloitte. I don't even know that they know we exist when they're doing a Guidewire implementation. Life doesn't get better for us because of these configurations. They're outside the standards. They're just not being programmed right. So we need to fix that. So I think that my gut feel is if the governance, the National Standards Governance Council, as a part of CSIO, really sinks its teeth into making sure that the standards are followed and interpreted appropriately, we should see return on that over the next few years insofar as improving our efficiencies, getting connectivity down the road quicker and accelerated. Does that answer your question, Tom?
It does, and it does. Thank you, and I'll add to a little bit. Since we talked a few years ago, I'm actually happy with some amount of progress. Like, you always want more, but there certainly has been a lot of progress. And I don't think 3 years ago, I don't think I understood sort of, all of the issues that were facing us, right, with improper use of standards and so on like that. But what I am seeing these days is a lot more people talking about it in the right way. Having the governance council, having a CSIO focus on EDOC remediation, having vendors focus on that and carriers focus on that, and actually coming together as an industry to get that resolved. We've got Wawanesa agreeing to share API work that they've spent literal millions of dollars on with other carriers, so that they can mirror their approach and make it easier for vendors and therefore for brokers to connect to that group of carriers that's following Wawanesa. That's huge, right? That didn't exist 3 years ago. Huge opportunity. I'm seeing emails go back and forth between Wawanesa and certain carriers who want to get a jump start on this stuff, right? So the tone is changing. And the people that I talk to now, I'll be clear, not every carrier is on board, but the carriers who are on board are now talking about it as a when it's going to happen as opposed to if it's going to happen. And that's a pretty big sea change from a few years ago. And Jeff, you sit on some of these panels. What's your take on it?
No, 100%. Like I've watched it where, I've heard people complain that you guys have been trying to fix this for years. I've heard SEMC, blah, blah, blah. All the people that say that haven't done a thing to help the industry. So that's what I usually throw back at them, because the first people to say that have done nothing to lift a finger. People like Steve, myself, Adam, and Tom have, I know I've been at this gig for over 20 years trying to improve connectivity. And I feel like we've never been in better hands. We have IBAC unified, speaking with one voice. So we don't have 35 people, pick me with, 34 bad ideas. We're getting, more limited stuff done, but more at scale. We've got paid help. We try to do a bunch of this stuff with volunteer kumbaya work, which didn't really get us anywhere fast. So now we got people like Tom hired to go do it. So, and again, we have the standards being enforced. CZO has really stepped up, I feel, in the last 3 years, because, making standards and never enforcing them, why have standards, right? So that's pivotal. So I really like what I'm seeing. It is going to happen overnight, no, but at least we're pulling in the right direction.
Okay, so that's good news. So we went through the bad news. We felt
well,
like
we didn't get all the bad news in. I think we missed some pretty big news.
Go for it. I was hoping to end. On a ray of sunshine, but
forget that. All those things can hurt. I don't think any of them can completely destroy us. I still feel, I know we talked to Don from my Insurance Bureau of Canada, probably in year 1 or year 2, just before he retired. We still have to look at earthquake. Like earthquake hits BC or California right now, and based on how bad the reinsurance market is right now, that could put us in a death spiral. So that's kind of a black swan event that we can't. I don't know if anybody's figured it out. I think everybody's reaction, hope it doesn't happen, but if that happens, that could really turn things into a tailspin. The other thing is banking collapse. The banks were a little bit shaky over the last 12 to 18 months with the Silicon Valley Bank and a few other banks. And again, the governments have been, not exactly ran great, and across the world right now, running up massive debts. We're becoming the banana republic of Canada here. We're almost getting to third world status with our debt. So we got to look at the risk of, banking insolvency. And if banking insolvency ever hit the insurance industry, where would we be? So these are some things that, again, you add those things together. We have to be aware of them. I hope it never happens. We hope we've done everything to insulate ourselves. But you talked about existential threats, like stuff that can wipe us out. Those things are lingering. And every year we don't have an earthquake of any magnitude out west. You're like, when's it due? And I'm like, oh, please don't happen now, because it could be the worst time to happen. So
yeah, gotcha. Thanks, Jeff. So we talked about vehicle theft, the impact of that. We talked about reinsurance and its impact, take all comers rule, OPCF 49, embedded insurance, all super negative. One little ray of sunshine with the progress on connectivity. And of course, Jeff had to bring us down and talk about how at some point an earthquake in BC is going to make my Calgary house waterfront property. Thanks, guys. As always, want to give a shout out to our sponsor, IFS Premium Finance. Thanks for helping us do what we do here. And Jeff, Adam, Steve, Thanks, guys, and season 7's on a roll.
Is retention important to your brokerage? Of course it is. That's why at IFS, we have a cancellation prevention process. Want more details? Give us a call. I know you don't always use a premium finance company, but when you do, you should use IFS. Cheers.